Reasons not to worry about a stock market crash. It's effortless to get spooked through a market downturn. But this is why you shouldn't be. It's almost impossible to say when the next market crash will happen. Many specialists have been convinced that stocks would crash late last year, or at some point of the first half of 2021, due to the truth that the market has been largely hyped up for a truly lengthy time. But that did not happen. But here's what we do know, though. The inventory market is apt to tumble eventually. But it is not something that motivates you to lose sleep. Here's why stocks go on sale during downturns. Stock market crashes are usually regarded as a terrible thing. But you are better off looking at them as an opportunity. When inventory values drop, you, as an investor, get a top opportunity to construct out your portfolio on the cheap. Say you've had your eye on a specific organization whose share price has hovered around $500. Now, let's say the vast market tanks and inventory values fall 20% throughout the board. Suddenly, you can scoop up those shares at $400 a piece, wait for the market to recover, and then earnings. Long-term buyers generally are not harmed through crashes. The stock market has passed through dozens of corrections periods where stock values dropped 10% or more in its history, and it has managed to recover from every single one. Short-term buyers might also have gotten burned with the aid of corrections. However, those who stayed invested for many years would have mostly come out ahead. If you undertake an investing method that involves buying best stocks and protecting them for decades, then you may put yourself in exceptional function to get via inventory market crash unscathed. Imagine you are in your 20s and are building an inventory portfolio for retirement. The only time you need to definitely be worried with a market crash is inside the 5 to 7 year window, earlier than your goal retirement date. And through then, you'll ideally have shifted some of your assets out of stocks and into safer selections like bonds. Anyway, you can stop losses throughout a crash by surely doing nothing. Simply owning shares at some stage in a market crash may not cause you any financial losses. It's when you go out and sell shares when they're down that financial damage occurs. What's the solution? Don't make any strikes when inventory values plunge. It's sincerely that simple. If you go away, wait things out, you may not be negatively affected at all. Rather, all you'll be doing is looking at a loss on screen. Not surprisingly, in a declining market, investors are often overwhelmed by their loss avoidance instincts and think they will lose more money if they don't sell. However, asset depreciation is often temporary and will increase again. On the other hand, if investors sell when the market is bearish, they will realize the loss. One lesson learned by many investors is that it is difficult to monitor market decline, and it is beneficial to stay calm and wait for a rebound, even if you are stuck in the market. According to a survey of 4,444, the average bear market is 1.4 years, while the average bull market is 9.1 years. The bear market has an average decline of 41%, while the bull market has an average rise of 480%. It is important to remember that the one bear market is only temporary. The next bull market will wipe out its decline, which will expand the profits of the previous bull market. The bigger risk for investors is not to miss the next 41st kink in the market, but not to miss the next 480% profit in the market. The past is not a predictor of the future. It should give you the peace of mind that going down will eventually tend to go up. If you enjoyed the video, go ahead and give it a thumbs up and subscribe if you are new to the channel. With that said, have a great day and I'll see you all in the next one.